Hey folks, it's ASIM Trading. I was about to start my weekend market analysis and I thought, why not record this? That way people can listen to my thoughts as I go through my own processes. And this is just my personal process that I do every weekend just to kind of get prepared for the coming trading week. I often start with this tab here in TC2000, which is basically my market monitor tab. This shows me the indexes, it shows me the breadth and the momentum underneath the hood. That way I can get just kind of a big picture view, and it kind of frames my thoughts for the coming week as far as like how aggressive should I be, how defensive should I be to avoid doing damage, things like that, just to kind of posture myself for potential courses of action. So as I've said in recent commentary, there was significant rotation out of large cap indexes like SPY and the QQQ, particularly in the tech sector, and then kind of this money flow into the mid and small cap sectors or areas, and then other sectors besides tech started kind of popping. And then the last several sessions, we've had a significant pullback in the large cap indexes. Initially I thought things would kind of stop at the 20-day, but things have been more aggressive of a sell-off, and that's the kind of thing you don't know this ahead of time. You can speculate and you can generate specific scenarios you think might happen, but those are just conjecture based on the information you know. So the large caps are they slice through the 20-day, and they look like they're heading towards the 50-day here. So this is a reasonable stopping point for these indexes, just to kind of hold for a little while. Again, this is just based on what typically happens. That doesn't mean they need to stop there just because I'm saying they do. This is just a logical resting point where things might chop around for a few days and kind of find support. So that's something that I'm going to be looking for in the coming days with these two indexes is, do they find support at the 50-day, or do they continue to kind of fall apart? And then for the mid and small caps, I put these Fibonacci lines here, not because I necessarily believe that Fibonacci is some kind of magical references. Some people act like it's some sort of magical system that's baked into the fabric of the universe. And it's like, no, it's not. It's really just supply and demand and crowd psychology and things like that. But if you take the lows of this move and you draw the highs and you put some Fibonacci lines, we're kind of in this confluence zone of the 10 and the 20 period moving average, and in the 38.2 and the 50% retracement levels. So I'm reasonably expecting in this general vicinity here, we'll chop around a little bit and create a little bit of a range, which is good. That's exactly what I'm looking for. I'm looking for a range to be created for a few days, which will help some of these pullbacks tighten up a little bit. It'll definitely set some stocks up potentially. So just looking for things to kind of slow down around here, and the IWM is a little bit stronger. It hasn't pulled back as aggressively as the mid caps, but again, like around the 10 period moving average, and like this Fibonacci zone here, I think that'd be a reasonable spot for these things to stop. This is the 50% retracement line. This is the 61.8, and same thing here. This is the 50% retracement line. So again, these all kind of line up, and there's a little bit of a confluence zone here. So that's where I'm reasonably expecting things to land. And then if you look at the internals, the new highs are still at a very healthy level above the new lows, and then the upward momentum is still in a healthy place above the downward momentum for the average stock. And that's generally what I'm looking for. So this is the overall number here of everything that's like micro cap and above. These are the large cap numbers, these are the mid cap numbers, and then these are like the small and micro cap and small cap numbers. And you can see none of them have fallen apart significantly. Even the large caps are still, you have the new highs is still sitting at almost double the new lows. Almost a 3-to-1 for the up versus down momentum. So even though the large cap indexes are falling apart, on the surface, if you look under the surface, you can see that the truth of the matter is that the average large cap stock is not falling apart. Again, a lot of this selling is concentrated in just a few stocks, very large cap tech stocks. But tech is not the only area in the market, and that's why I look at all these things together, because it gives me a more accurate picture of what's going on. So the fact that I see these numbers are still kind of maintaining their resilience in the face of this sell-off, to me that's a normal corrective sort of sell-off, and it means to me that, and I hope this is the case, that things kind of stabilize and then we kind of rebound and have a continuation of this rally, at least for the mids and the smalls. If we go to the sectors, this is sorted by the 1 month relative strength. So you have real estate, financial services, and comm services as the top three. Healthcare, utilities. So I mean, this is not the kind of composition that you normally want to see in some sort of growth-oriented rally. These are all interest rate sensitive things. So if you think about it, real estate, utilities, financials, like these are interest rate sensitive areas. So the fact that they're basically leading the market right now is just indicative of the environment that we're in. But these indexes, they had this breakout from this long base, and this is a first thrust out of this long base, and this is the first pullback. So this is a healthy spot to be in. Same thing for financial services. This is a first thrust out of this long base. If you look at previous moves like that, whether it's a first thrust off of a multi-leg down move, you have a first thrust and then a correction, and then you have a continuation. If you think this as a range, you have a thrust out, correction, thrust out, correction. So again, like this is just a first move out, and this is the first correction. So reasonably, if things hold and the buying demand continues, then we should see this stuff tighten up and then move back to the upside. Tech, on the other hand, it's kind of shit in the bed. So this is one area that I wouldn't necessarily avoid it, but it's definitely has money flows coming out of tech and not into it. So that doesn't mean that all tech stocks are just going to completely fall apart. It just means I would be a little bit more careful in the tech sector, just because it seems to be a little more news driven, I guess, at this point. The big institutions, they look 6 to 9 months ahead. They position themselves based on what they anticipate to happen down the road, not what's currently happening right now. So this could mean that maybe down the road they expect a tougher interest rate environment, which is not good for growth stocks. It could mean that the growth is not, on the horizon as far as their analyst projections go, and maybe that it's creating some sort of rotation out of tech, or at least certain tech stocks. And if you look under the hood here for tech, the average tech stock is not doing so great. You see the new highs number here is less than the new lows number. That means more tech stocks are making new lows versus new highs. And then the up momentum versus down momentum is almost at parity here. So that just means the average tech stock is not very healthy right now. So again, I would keep that in mind as you go about your trading. You want to be in the flow with where the money flows are going. The money flows are not going into tech right now, so that just makes the environment for tech stocks a little bit more challenging. It means breakouts are going to be failing more often. There's probably going to be less setups and things that are available. When things do break out, maybe they don't follow through as much. And again, that's just in general. It affects your overall statistics, your overall expectancy for that area. So just keep those things in mind. And if we go to just the actual stocks themselves, as I've showed several times before, I just have a very basic scan of just some relative strength parameters: 1 month, 3 month, 6 month, and 2 weeks. I mean, maybe this should be at the top if you want it in the right order. And as I've said before, like that's not exactly 1 month or 3 months or 6 months. It's just it's a rough ballpark, and it's the top 10% of those stocks. So basically, what it's pulling out is the top 10% of these 4 time periods in terms of relative strength and relative price performance. whatever charting platform you use. If you don't use TC2000 like I do, then try to recreate something similar. But what this does is this always keeps you in touch with stocks with the highest relative strength. Numerous studies have shown that strength begets strength. So during a momentum phase, the strongest stocks tend to stay the strongest stocks. And during a corrective phase, the stocks that have the highest relative strength are the ones that are retaining that sort of momentum. In most cases, they're not falling apart as much. It just, so if you only look and analyze the top 10% of the stocks with relative strength, then you kind of get the best of both worlds. You're always in touch with the stocks that are moving the fastest, and you're always in touch with the stocks that are holding up the best. And so that gives you a very useful list of stocks to continuously be in touch with, because those are the ones that are often going to make the biggest moves whenever the market is in a positive phase. Some measure of liquidity. I have 20 million here, 300,000 shares a day, 20 million of daily dollar volume, which is the average volume times the price. You can put whatever you want. I mean, there's some general rules of thumb. Is you don't want to trade stocks where your position is going to account for more than 1 or 2% of the daily dollar volume. So basically, if you just take your position size and divide it by 0.01, that should be your number that's in here at a minimum. I would say that those with much smaller accounts, that's not going to be very useful, because your position sizes aren't going to be very big. You still have to account for the fact that it's institutions that are driving most of the price movements, and institutions are not going to touch these super illiquid stocks because they can't establish adequate positions. So your baseline should be 10, 20, 50. Some people, if you have very large accounts, maybe 100 million could be your minimum daily dollar volume. I would just put some liquidity figure there that pulls out stocks that are gonna have tight enough spreads, have enough liquidity where you can get in and out without affecting the price. Because sometimes you have to buy in a hurry or sell in a hurry, and if you're having to deal with a bunch of slippage because you're trying to dump a bunch of shares into a stock that's not able to absorb that supply, then you're going to run into problems. Or if you're trying to buy a bunch of shares in a stock that can't absorb the demand, you're going to drive the price up on yourself. So that's just one consideration, is the liquidity of the stocks. Average daily range, I put mine at 5%, but this is just the average price movement over the last 20 sessions. So that just tells you how volatile the stock is with its price movements. I want stocks where the 10 period moving average is above the 20. That just shows that it's in a general uptrend. And then I want stocks that have held within 30% of recent highs. This is the 1 month and the 3 month. Just showing that whatever momentum that it did have, it's retaining that momentum and it hasn't fallen apart. Because once it starts dropping 15, 20, 30% off of its highs, then it just becomes increasingly more difficult for it to actually overcome that supply. That overhead supply becomes a problem. And so you want to make sure that the stock has some clear skies above it, so that way when it does break out, it's not going to run into a bunch of overhead supply. Again, so these are just my general criteria that I use just as a general filter. And if I run that basic filter, I end up with almost 80 stocks. So out of the 10,000 stock universe, those basic filters will pull out about 80 stocks, and that's a very manageable list. Anybody should be able to analyze 100 stocks at a time and try to pull out a list of stocks that they're going to trade for the week. It's yes. Does it take practice? Sure. Does it take procedural memory? Yes. But you have to start somewhere, and why not start with the best of the best? Why not start with stocks that have volatility, liquidity, relative strength, momentum, trend, all those sort of characteristics? Those are a fertile ground for you to find stocks that have a lot of potential to move in the direction that you want. And so once I have my list of I try to keep my list below 100. So anything below 100 to me is a pretty good list. sometimes these numbers will increase or decrease based on these two last criteria. So often what happens during a market correction is a stock will fall, a lot of stocks will fall more than 30% from their recent highs because, they're in a downtrend. They're kind of falling apart and not being supported. Or the 10 will go below the 20. So like a lot of times these last two criteria right here will kick a lot of things out during a correction. So this list, maybe it's 40 stocks instead of, 70. I mean, I often don't find this number like far above 100. Sometimes if the market is really healthy, the number will it'll increase above this number here, but that's okay. Like I've done this so many times for so many years that like I can get through this list fairly quickly. I'm just being deliberately slow today so I can explain my thought process. So often what I do is I'll sort by the daily, by the volatility number, just because I like to look at stocks that are the most volatile first. Yeah, I mean I could start here down at the 5% range, but I really want these really frisky stocks. A stock that's really frisky and really liquid, those are the stocks that tend to make the biggest moves. And they provide a lot of opportunities for trading. So, another thing that I like to do is I have these Bollinger Band widths here. So basically, like, I'm looking at the average daily range over the last 20 sessions, and then these show me what's the range within intraday. That way I can compare the two numbers. So oftentimes what you'll see, so let's say this is 14% for the average daily range, and then the intraday Bollinger Bands, or this is 40%, this is 35% for this RGS stock. So it's like without even looking and clicking on this chart, I know that this thing is already like, it's beyond some sort of reasonable buy point, because just by doing this for so long, I know that when these two numbers here are close to this number here, then that means the stock is kind of in a compressed state, and it's more likely going to be in a situation where it might be buyable soon. Whereas when these two numbers here are far above and beyond this number, then I know it's already made its move. It's already expanded, either up or down. That doesn't mean this has moved up. It could have gone down. It could have expanded in the downward direction. So if I click on this stock, I can see it was tight. So like it's been moving up for 2 days. I highlighted this stock a couple times in recent days. So it's already made its expansion move, and this purple bar here, the purple bars just show that this is an above average price range, and then the white bars, then this is just the way that I color my bars. The whites show a below average price range, and then the purple shows an above average price range. And if it's just normal green or red, like the bars usually are, that's just an average size bar. So you can see the stock, it gapped up, it compressed sideways. You can see all these white bars showing like very below average range, and then it expanded out of this. So a couple days ago, when this thing was in a compressed range, that's when you want to be looking at the stock waiting for the breakout. At this point in time, it's already moved, so this would not be a point where I'd be looking to buy this thing at all. That means you missed. That means you missed the breakout. You should have been watching this thing down here. And that's why you have to do this exercise regularly, because you want to see this stuff coming. You don't want to see the stock here and then be chasing it. You want to see the stock here and anticipate, okay, this thing might break out in the next couple of days, which it did, and it expanded out. But again, just by looking at these numbers here, I don't have to even see the chart to know like what usually happens. And again here, like this 14% is the normal range, and this is 182 and 160%. And of course, like this thing had a massive move. This is probably some sort of gap move. But if I click on the chart, then I can see that it had a gap and it moved out. Some people trade gaps, and that's fine. I haven't had a lot of success or consistency with gaps, to be honest. I mean, I do like to study them. I'll kind of mark out the gap and just kind of study the characteristics of the gap, just to kind of like ingrain that in my brain. But I often don't have a lot of success with gaps. There's a lot of slop and inconsistency that I've found. I've found a lot more consistency with just the way that I normally trade. So I tend to just skip gaps and not even worry about them. And you see the difference here. So this is 14 and then 10 and 7. So this is what we're looking for right here. So like I said, before I even click on this chart, like I'm already thinking EOSE is going to be in some tight compressed range because its normal volatility is 14% and intraday right now it's only 10 and 7 based on the hourly and 30-minute. So again, if we click on the chart, and I've already kind of like drawn some of this stuff out, and you can see this thing over the last several days, it's building this nice range. So this is something that I would have on a watch list. I would flag this thing as something potentially buyable because it's starting to build higher lows. It's starting to build out this range. And it's building the characteristics that I tend to look for when it comes to the setups that I target. And another thing I like to do is I like to mark out the lows and the bottoms and study these things because that shows me and ingrains in my mind the characteristics of these stocks whenever they bottom and then rally out of that. And you can see, like, even though these three bottoms led to some sort of decent rally, none of them look the same at all. And then that's kind of the challenge with trading is a lot of times people look for these very rigid and structured sort of basing patterns and setups, but stocks don't move in a rigid or structured manner at all. There's tendencies and consistency with those tendencies, but there's definitely not some rigid method by which stocks move. But one thing I like to do is by marking out these lows, what I often end up ingraining in my brain is the same thing that you hear a lot of traders talk about, is like these ranges start to get built. And this is exactly what I'm targeting during the trading day. Is I'm looking for this, so you imagine, if I'm staring at the stock right here at this point in time, this is an hourly chart, so obviously the bars are going to move hour by hour. But this stock, it sold off, so it had this period where it sold off, it turned the moving averages down, which is normal. These sell-offs are normal. It starts to pull into this 10 and 20 period moving average zone, which is this dashed purple and yellow line. And if you kind of step the price action forward, there's a point where it breaks out of this range. So this, for me, is where I'm looking to buy. So when I see this range get created and it starts to break out of that, and this is, what Kale would call a wedge pop. This is just on the hourly chart. It has this wedge drop. It has a drop. It wedges. Wedging is just like these declining moving averages. It's bumping into them and it's kind of wedging and building higher lows. That's the wedge, and then the pop is the pop out of the wedge. And then it just keeps on going, from there. So they don't all work that perfectly, but they work very consistently. And you can even see a similar sort of structure here in this previous low, where you had a drop. It starts to wedge into these declining moving averages. The lows start to get higher. It kind of compresses and then it pops out of there. And that's just the way that these stocks move. And if you just keep doing this process over and over again, you'll see that this is just how price action moves in stocks. So by doing this drill a number of times, one thing that I notice is, so if you kind of mark out these areas where the stock moved for several days in a row, and you think about, okay, what happened right before that? What happened right before that? What you'll often notice is the 10-day at a minimum will pull back. Not the 10-day, the 10 period on the hourly will pull back, and it'll kind of hook down. And that doesn't mean the 20 period is going to hook down, but like at least the 10 hooks down. And then it kind of stabilizes, and then it breaks out of that. And that's often the case. And that's essentially a basin break. I don't know if that's exactly how Kell defines it, but it's essentially a basin break where it's like the price remains above the 20 and the 10 remains above the 20, even though there's a little bit of a corrective action there. Whereas if you have the moving averages sloping down completely like this and the 10 actually drops under the 20, that's when you get into this wedge pop sort of territory. Whereas this is more of it's a shorter pullback that all it does is pulls the 10 period back while it still remains above the 20 period. So that happened in this situation where, it just had this kind of V-shaped bounce. And again, there isn't this long structure, and it's like a lot of people don't trade these V-shaped bounces, and for good reason. They're a little bit more failure prone in many cases, but I've definitely seen plenty of them work too. So it really just kind of depends on your risk tolerance there. Similar situation here, the 10 period starts to hook down, but it remains above the 20. You see there's this gap here between the 10 and the 20. It starts to build higher low as it builds this range, and then it breaks out of it again. And you have this, the move didn't last long. If you look on the daily over here, this was kind of a 3-day move. But this would have been far enough of a move to get a decent risk reward before it rolled over. And now it's kind of in a situation where it's building yet another range. So that's just, as you're analyzing these stocks, this is what you see now. Like you're not going to know, is it going to do this here? Like who knows? Like that's not something you're going to be able to know ahead of time. All you know is that right now it's building out a range. The 10 and the 20 have sloped down, just like in the other scenario. It's starting to build higher lows. It's starting to tighten up a bit. That's all that you can assess at this point in time. Is it going to break out from here? Who knows? Is it going to break down from here? Who knows? That's not something that you're going to know ahead of time. All you do is understand what's happening now, and you anticipate scenarios. And the scenario that I it's kind of like with poker, where it's like, okay, like if I know I have the starting cards for, let's say, a straight, I've got 3 out of the 5 cards for a straight. This would be like having 3 out of the 5 cards. Okay, let's say this thing starts to like pop out of here. That might be the 4th card out of the 5. And it's like if it continues to follow through, okay, like I got the 5 cards for a straight. That's a winning hand. But let's say you have 3 cards for the straight, and then it drops down to the bottom. Okay, you never got your 4th card. Just because you have the first 3 cards of a straight doesn't mean you're ever going to get the 4th card or the 5th card. So if you kind of think of that about like trading like poker, as the price action unfolds, you either get cards or price action that supports your hand, or it doesn't support your hand, and you have no control over that. Just like in poker, you have no control over which cards come next. In trading, you have no control over which price action comes next. All you can do is know, based on the current setup, I need this to happen in order for this to be a successful trade. And likewise, you need to know, I need this to happen for the setup to be invalidated or fall apart. So just because this looks tight and structured doesn't mean it's going to break out. Like if this starts to break through the bottom, then it invalidates the setup, and then I just kind of take it off my list for that period of time. Again, like these are just, these stocks just happen to be on my top relative strength list, but these are stocks that have been on my list for months and months, because that's what tends to happen with high relative strength stocks, is they'll be on your list for months and months and months. Because stocks that stay strong, they tend to continue to be strong whenever the market is in a good phase. But again, if you just kind of go back in the price history of this stock, I mean, you can see a similar sort of setup. Even here, like the 10 hooks down, but it stays above the 20, and then it pops out of this range. Let's imagine that we were looking at this stock back here. It's the same sort of situation. You have this price range, and then the price expands out of it. I mean, this would be a trade that I would take. Did it follow through? No, it didn't follow through. Would I have known that when I took the trade? No. But you have no control over what happens after you enter the trade. All you can do is look for high probability setups, enter them appropriately, set your stop and your appropriate risk level, and then you manage the trade from there. That's all you can do. So this trade, this probably would have scratched out, probably for a break even. Maybe if you had taken a little bit off, maybe it could have been a small profit. But that's just the way it goes. Not every trade's going to be a big winner. And then, it proceeds to build out a longer range. And again, like it starts building higher lows, it starts to compress in this range, and then it breaks out. I mean, could you have bought the breakout here? Sure. Like, could you have bought it here when it tried to break out? Sure. Like, there's other scenarios where it's like you could have gotten sucked in to this with false breakouts. But, if you look at the volume here, the volume wasn't super great, so maybe you would have passed on it. And there's just a lot of different variables you have to deal with, and you can see even though we've only been through a couple of stocks here so far, none of them have been exactly the same. There's some general tendencies that are consistent, But that doesn't mean what you see on a bar by bar basis is ever going to be the same. And again, it's the same thing with poker. You're looking for general suits and general winning hands, but the cards that end up being in those hands and suits are not always the same. If you think about just a straight or a flush, those could be comprised of any number of combinations of cards and suits and still be a flush and still be a straight. And it's the same thing with price action. Like, just because the exact bar by bar, it doesn't line up exactly the same, doesn't mean the general structure changes. So if I could encourage you to think about trading in any way, like think about it like you're playing poker. Look for general structure and general tendencies and understand that those are what you need to be focused on, not on these exact scenarios playing out. And that's why a lot of times system trading is kind of this well-intentioned sort of methodology, but it doesn't actually work in practice because you can't box the market into a structure that defined, because price action doesn't move like that. So again, what I like to do is I like to look at where these movements happen, these runs of bars, and then I look at what happened right before the run. And oftentimes it's going to be some sort of compression on the hourly. So this is the hourly. You're going to see lots of white bars, and there's going to be like a sideways range, and then it pops out of there. Lots of white bars, sideways range, it pops out of there. And just right here, there's a series of white bars, but that's not giving you a range. Those are kind of like stepping higher rather than like this sideways range. You want this kind of sideways compression range. You get lots of white bars, you get some sideways range, it breaks out of there. And again, this is the general structure and the general tendencies that I'm looking for as I'm going through the market and trying to figure out which stocks am I going to buy. And you also want to study failure too. So, let's say that you were, let's say this is where you were seeing things. I mean, that looks like a pretty damn good setup. It's pulling back, it's building higher lows. You start getting lots of white bars and you start getting this sideways range. Like at this point, would be looking for a breakout to the upside. Guess what? That doesn't happen. You don't always get what you want. So it's one of those things where it's like, just because this shows up on your charts doesn't mean you're getting a breakout. But you need to be watching this stock as if it was going to break out, because, again, you have a range here. At this point in time, you don't know if it's going to break lower or if it's going to break higher, but you have to have this on your watch list and you need to be watching and waiting. And this one happens to break out and follow through. So again, I would encourage you to study runs where basically you have these runs of price action, which on the hourly chart, it's going to look like a lot of these, up expansion purple bars. Even on the daily, you're going to have runs of 1, 2, 3, 4, 5 days in a row, or, a series of up and down days during an uptrend. But what you want to really do is take these runs and then backtrack. Okay, what is the origin of that run? What did it look like before it broke out? And oftentimes what you'll find this tight constructive price action and then a breakout and a run. Tight constructive price action, a breakout and a run. And then this stock starts getting super sloppy, to be honest. And here's another good example right here. It's like this could have been confused for, a wedge pop. It has the moving averages turned down. But you don't really get any sort of nice tight price action here. You kind of get just this sloppy sort of shit. But even if you had taken this, let's say you saw this high volume breakout, it breaks back up through the moving averages and it kind of clears this range here. Okay, that would be a valid trade. It's like, okay, let's say that was your trade. But as soon as the price action starts to roll back over, then that's an indication that the trade is not working like you thought it would. And that's another thing that you need to do. Is even if you get into a trade that looks, exactly like hundreds of other trades that you've taken that worked, just because this looks exactly the same doesn't mean it's going to work. And you have to evaluate each trade on its own merits. So this thing, it starts out okay. Even if it does this, that's still not necessarily a bad thing. Now you have this high volume break, and then the pullback on the volume is actually pretty constructive. So if I had bought this wedge pop through the moving averages, I probably would still be holding it because it wouldn't have violated my stop yet. But then, as this thing continues to like melt down, it's like, okay, at some point you have to make an assessment of like, okay, this thing is not acting normal. Like after this pullback here, this thing should have been at new highs. Like this is the action you want to see is if it breaks out, chops around a little bit, and then it it hits new highs relatively quickly. But this thing doesn't do that. So that's another thing you should keep an eye out for is the resiliency of the stock. A stock that's in demand is going to be hitting new highs on a regular basis, new intraday highs on a regular basis. Doesn't mean it's going to hit like it's just going to squirt up and just disappear into the stratosphere. But what you want to see is this steady upward thrusting of the stock being bought up, expanding, hitting new highs, shallow on its pullbacks. But if it starts struggling with that, where it's starting to hit new lows, and you see this thing is starting to like make a W down and hit new lows after this breakout, it's like, okay, that's the point where you're reevaluating and most likely getting out of the stock. And if you keep holding the thing, you're just going to end up with something like this, where it just keeps kind of melting down. Like you don't want to take a stock where you should have exited here, and then you're riding it down another 10 or 15%. That's not very good risk management. And again, like here's just another example of, okay, so this wedge pop didn't work, so this would be failed. This would be a failed trade, and then you wait for it to reset. Okay, like it starts building a series of white bars, sideways price range, and then it breaks back through the moving averages again. Like it doesn't look exactly like this one, but it looks pretty similar, right? And even the breakout, if you look at the breakout, it looks similar. Like it broke out, it kind of chopped sideways for a little bit, but you can see this thing goes and hits intraday highs on a regular basis after the breakout, whereas this one, it broke out and then it starts going the wrong direction. So just when you think about how the price action unfolds, these sort of indicators after the breakout are what's going to tell you whether you hold the stock or you fold the stock. In this situation you would fold, in this situation you would hold, even though it looks relatively similar at this point and this point. Yeah, and this is one I've just marked up. So I mean, this one had a series of bounces off the 10 and the 20. And again, just for education purposes, you should mark these things out. Even if you didn't take the trade, mark it out anyway, just so you kind of like understand before a run. I have this situation where the 10 sloping down, it stays above the 20, so this would be like a basin break. And this doesn't have a higher low, but if you imagine what a descending kind of a flag pattern would look like on an intraday basis, that's what this stock did. And then it broke above this range and it made a run, and then it goes sideways, it builds a range, breaks out, and again, like how long this thing runs after the breakout, you have zero control over. So you can see that this run here is a similar length of this run here. And then you get another range. So whereas these two, it just turned the 10 down, but it stayed over the 20, turns the 10 down, but stays over the 20. This actually causes the 10 to go under the 20. So this is a little bit of a deeper correction. But again, same sort of scenario. You start building these white narrow range bars, you start building a range, and then the stock breaks above the range. This doesn't follow through. This stock is actually, even though it bounced a couple of times off the 20, off the 10, it actually didn't make a lot of movement after the breakout. So you can see like it only had one up day, and then it was 2 or 3 down, one up day, 2 sideways, one up day, 2 or 3 or 4 down. So this stock, after this initial move, it was incredibly choppy and didn't actually make a lot of progress. And again, you only know that after the fact. You don't know that that's what's going to happen. You basically just identify the setup, identify the breakout, and where your stop would be, and then you just ride it as long as it goes. And you have no control over that. Again, it breaks out, doesn't go far, sets back up. I mean, if you just look at these two setups, they look very similar. The 10 crosses the 20, it starts to chop sideways, you start having these white narrow range bars, you build a range, you break out. Again, like this is just the way that stocks move over and over and over and over again. you get to this setup here. This looks similar to the start here where the 10 goes under the 20 and they both are sloping down. But you can see this doesn't look exactly like this, and that's why you should just study these things and understand. It's like, okay, let's say you did buy this. I mean, that looks kind of sloppy and the range isn't very good. Let's say you did buy this breakout above the 10 and the 20, thinking that it was going to follow through to the upside. Well, guess what? It didn't. So at this point in time, 2 bars later, this thing's starting to shit the bed. It's like, okay, like that's your sign that this isn't working out like you thought. If it breaks through the 10 and the 20 like this and it follows through, that's what you're looking for, that follow through, that constructive price action. Whereas this, if you bought this here and like the next bar it starts to reverse and starts going the wrong direction, this is your sign to exit. But guess what? A few bars later, if you just wait a little bit longer, it sets up again. Like it starts to chop around, build some white bars. And this isn't this exact sort of sideways range action. And that's why I take these setups often. I'm not always looking for this like very tight, constructive, higher lows sort of pattern. Oftentimes these are going to be where you're going to get the best bang for your buck, is when you get this kind of higher low, higher low, higher low before the breakout. That's ideally what you want, but oftentimes you're not going to get that. So I'm the kind of trader where I will take these wedge pops that don't really have a nice clean looking higher low on it. I might take a smaller position just because it's a little bit more risky, but that doesn't mean I'm not going to take it. And then we're in the process here where it's starting to kind of build another sort of range out. And one thing I actually want to draw your attention to is if you look at the daily chart on here on the left, notice all these circles that I drew here without even really trying to. Look at what the price action does during these points in time. Like, so visually, like if you don't like the noisiness of the hourly charts, some people don't like how noisy they are. If you look at the daily, these end up being these kind of small candles, small dojis that you often read about in like candlestick books. So the reason a lot of those candlestick patterns are effective and they work is because that's just how a stock looks when it pauses before a move higher. Again, it's not like completely consistent with candlestick methodology, but there's quite a bit of alignment. And again, without even really trying to, I was just drawing out the intraday price action on the hourly here. If you overlay that on the daily, it ends up corresponding quite well with other methodologies. If we just continue our analysis here. And again, like, what I'm doing is as I'm going down this list, I'm looking for stocks that are they in a buyable position? Like this right here, this is sloppy and loose and all over the place. This is not something that I would really focus on. Whereas this, again, like you have this price range, you have all these white bars starting to be built, you have higher lows being built, it's starting to compress. The intraday volatility is compressed relative to its normal volatility. Like this is the kind of situation that I would probably be interested in. One thing I don't really like is that it's in the tech sector, but this is a kind of a low capitalization stock. So this would be, what is that, a small cap stock. So, this could potentially be able to buck what the large cap tech is going through. But again, like just based on the setup itself, I would consider this to be a good setup. It's like this. This is just wide and sloppy, not something I'd be interested in. And now I'm going to go a little bit quicker through these, just to kind of show you, like this is wide and sloppy. So if the stock is already up several days in a row like this, I would pass on that. Let's say this was what I was currently seeing. If it's up several days in a row, I would immediately pass on it. If it's sloppy and loose and wide, I would probably pass on it. If it's not showing some sort of series of these white bars here that's going to give me a possible range to trade off of, then I'm going to pass on it. Like this is starting to look like I want it to look, but it just hasn't had enough time. So like, this candle here, I don't even know what the hell the doji name is, but whatever this reversal candle is, a hammer or whatever, I don't fucking know. if I look at the big picture context, it had this nasty sell off and it's just been kind of slopping around. So it's like, this is probably not something I'd be interested in trading just because the overall sloppiness of the pattern. And just the fact that it hasn't had enough time to really build anything out. Whereas if you look at Cypher here, it's had a first thrust up. It's, like this pullback here looks kind of sloppy, but in the context of this up move, this doesn't look too bad. If you look at this other one here, this is just kind of like slopping around widely in this range. So this is starting to build what I'm looking for. You have these series of white bars being built. You have this sideways range. So what I'm looking for is this thing to pop out on the upside, basically break above this range, and follow through. That's for this situation what I would be looking for. And again, like all I can see right now is this price action. I have no idea if this is going to continue to break down, if it's going to just chop sideways for another couple days. Like I don't know. You don't know. Nobody knows. But I can do some scenario development, be like, okay, like what scenario do I want to see? I want to see this thing break out and build higher lows and break out. And then I'm looking for information. The information is the unfolding price action. I want the unfolding price action to either confirm that thesis or reject that thesis. So, that's all you're doing is price action is just information. That's all that it is. And that information is either supporting your thesis or it's it's basically rejecting your thesis. What a lot of people do, though, is the price action is rejecting their thesis and they just stubbornly ignore that information rather than using the data that's unfolding and coming into your purview as something either supporting or not. If the information is not supporting your thesis, then why the hell are you in the trade? Your ego, probably. Not a great reason. Again, this is kind of sloppy here. It's not really building out the range that I'm looking for. This, on the other hand, if you want to mark this out. Again, this is the kind of situation that I would be looking for. It's a biotech. Not super thrilled about that, but the other factor that I need to mention is you need to keep an eye out for earnings or news releases. So it's the 20th of July. This is showing the 1st of August as its earnings release. So, if this were a trade I would take, it probably would be more short-term oriented. But I know for now, if I flag this thing, it's got down sloping 20, the 10's under the 20. It's starting to build a constructive range here. I would be looking for this thing to break out. And whatever you use as your breakout point, that's kind of on you. Like you can use the upper Bollinger Band. I use that quite often as a reference point of it, moving above recent resistance. You can draw trend lines. You can just eyeball it and like in your mind think like, is this breaking above the range? Like you don't need any of these indicators. You can just use your freaking eyeball and like visually see like, is it breaking above this range? It either is or it isn't. If it's down here moving that direction, that's not what you want to see. You want to visually see it breaking out. So that this is looking not super great. This is a little bit more V-shaped. I would like to see this thing kind of trail off a little bit more, but it's starting to build a little bit of a range. And you can see on the daily, it's kind of building this this contraction candle here. So this I would want to see this move above this area here, or to continue to do that. This is a situation where it's like it's getting the series of white bars, but they're kind of like trailing down. I'd rather see them move a little bit sideways, or at least kind of. It's better to see the white bars kind of build in a sideways sort of pattern and kind of build higher lows rather than this. This is building lower lows, even though the price action is kind of tightening up. Now, if this thing broke back up through the 10 and the 20 on the hourly, I probably would still take that. Like I've seen plenty of those situations as they're pulling into the 10 and the 20 on the daily. So that's what this purple and yellow dash line is. They'll kind of eke down into this 10 and the 20. Maybe they don't give you a nice higher low setup. But if this thing were to reverse the price action and go back through the 10 and the 20 here and kind of clear this range, that's all that I need to see. That's enough information for me to initiate a position. I don't need to think about anything else as far as at least the price action is concerned. This is, starting to shape up, but again, like if you just use these very simple tools, these circles, if the price action isn't poking up through the top of the circle, then fucking pass on it. Like there's like what else do you need to know? That means it's not going in the right direction. You don't even need to use trend lines. Just like draw these circles, and if you don't see the price poking up through the top here, then it's not ready yet. Of all things, it might continue to chop sideways, or it might break through the bottom. Again, just take a circle, draw the circle around the price action. This hasn't really built out enough of a range yet, but you can see it has this hammer candle as it pulls into the 20. So ideally this thing might chop out for another day or two, but like this thing is the same sort of scenario that I've pointed out before. The 10's under the 20, it's sloping down, it's starting to build out a range. So again, let this thing range out a little bit. Maybe it does range out for another couple days. And then again, if it breaks through the top of this circle, back through the 10 and the 20, that's your signal to get in. Nothing else needs to be known. This one's looking a bit sloppy, but this is one that I actually took, and it's the same shit over and over and over again. I think I took it down here. And you have this price range. And again, this isn't super pretty. Like for people that are looking for perfection, like okay, like look for perfection. You're gonna miss a lot of trades. I take a lot of trades that some people would kind of turn their eye upon and be like, oh, that's not some perfect looking setup. I personally, if it's in some sort of zone, or if it's like near the 50 or the 20, and it's giving me a range and it's breaking above the range, I don't care what anybody's opinion is. I'm going to take the trade. It's my money. If you don't want to take the trade, then don't take the trade. It doesn't bother me, and I won't lose sleep. You got a range, you got a breakout. Like this thing didn't follow through a lot, but I was able to get a function of my risk. I was able to get several R of profits, take some partials, and then this thing just ended up kind of rolling over, so I ended up getting out of it. So it's like that's just the way it happens for many trades. They're not all going to be runners that you buy it here and it runs up this way, for hundreds of percent. In fact, most of them aren't going to be like that. This would be more of a traditional sort of flag here for Nova. But again, like even if you just drew your circles, you got the same sort of scenario here. The 10 turned down enough, to kind of like create a range. You have this sideways price action. You draw a circle around it. If it breaks through the top of the circle, then you buy the fucking stock. If the volume is there and it meets all the other criteria that you have, then you buy the stock. This one tried to break out. I've been in this one a couple times. Actually, I made a decent amount of profits on this thing, but it's been super sloppy. I've been chopped. I got chopped up a little bit in this area here. I made some small profits here. I made some small profits here, but it's like this stock has been kind of frustrating. I think everybody was staring at the the earnings and the revenues, and it's fairly liquid. It's got 160 million daily dollar volume, but it's like overall after this big move here, it's been rather disappointing. But that doesn't mean it's going to completely fall apart, and this thing could still work. But if you take your price action, you draw a circle. Like okay, like I'm looking for this thing to break through the declining 10 and the 20 to the upside, and if it does, then maybe I'll get a position. But again, this thing's in tech. Tech isn't doing so great lately. I'm not going to go through every single stock here. So I'm just walking through my process of how I identify which stocks I'm going to ignore for the time being, which ones I'm going to flag and pay more attention to, and how I kind of slowly build up my list of stocks that I'm going to be trading for the next trading day. All right, I hope you found this to be helpful. Leave any comments you have in the chat, and I'll talk to you guys soon.